Fed Jerome Powell did it again, ladies and gentlemen. He gave us a bombshell that the markets kind of sold off on. They're kind of starting to recover a little bit. We'll see what happens by the end of the day. But exactly what Fed Powell just said. Powell, quote, says inflation data really changed beginning in October. Quote, we won't hesitate to raise rates above neutral if needed. Quote, Powell says neutral rates not a stopping or looking around point. That is the bombshell. Right there. Powell says neutral rates not a stopping or looking around point. That's essentially saying that, hey, we could go higher than 2.5 to 3.5%. He's saying we're going to go as hard as we need to get inflation down no matter what happens to the economy. Basically saying the economy can handle it, but at this point we are on a crash course into a recession. And Fed Jerome Powell's basically saying like, hey, even if we get a small recession, we have to get inflation down. So the markets initially sold off because of this. Now we're hanging out at the bottom end ranges of today. We'll see what happens here in the last hour or so of trading, but this was big, and it would not surprise me to see the markets digest this as negative or potentially just slightly neutral, but this is a very big deal. So I want to talk about exactly what has been going on today, potentially what this could do for the market, so on and so forth. Hit that like button, subscribe to the channel, and source those comments, questions, or concerns down below in the comment section. And make sure to get your free stock with Webull, Moomoo, and Public down below in the description as well. Now, let's get into this video and what actually happened today. We had some good news, we had not so good news, but by and large today was not a bad day, with the S&P currently up 1.21%, NASDAQ up 1.65%, and the Russell 2000, the most beaten down index, is up 2.5%. The biggest bullish news that we got today was Shanghai to end COVID lockdown and return to normal life in June amid economic slowdown. So that is very good. China, obviously the second largest economy, like Powell just said, one of the main manufacturing hubs of the world. So when you have supply chains getting messed up because of China, then you're expecting to see some inflation. And basically what Powell has been saying, the longer this goes, the harder it is to get inflation down, which is what we already know, but the Fed is acknowledging that. And that's what was different in the last Fed report, is that the Fed actually named China and COVID lockdowns as a problem, and now we're starting to see some of those kind of starting to lift. So the sooner China goes out of this lockdown thing, whatever you want to call it, whatever they're doing over there, that's going to be very, very positive for the markets, and that's a big reason why the markets are actually positive today. Now, on the other hand, our retail numbers came in a little bit less than expectations, but still pretty good. And it says the key points. Sales rose 0.9% in April, just below the 1% estimate according to numbers that are not adjusted for inflation. April's gains were powered by a 4% gain in miscellaneous retail and 2.1% jump in online sales. A separate report showed the industrial production rose 1.1% in April, well above the 0.5% estimate. So by and large, the retail numbers could have been a lot worse. So that's going to be a positive thing. Retail sales could have came in negative, right? So the fact we were pretty close to estimates is a good thing. The markets, they don't really care about that 0.1%. Good retail sales kind of show that, hey, maybe the economy is not in a recession. Maybe it's not heading into recession here in the near term future. And maybe some of this pricing in has went a little bit too far too fast. By pricing in, I mean the NASDAQ at the peak down 30%, still down well over 20%. Maybe too much was done too fast, and that's why you're seeing a bounce today. But these Fed comments are absolutely mind-blowing right now. And honestly, did not expect the Fed to say that. Like, neutral has been seen as the rate where the Fed might actually start to back off, and neutral is essentially, boil it down like this: when the Fed is not either accommodating nor restricting economic conditions. So it's a neutral rate. They're not helping, they're not hurting the economy. And that's where a lot of people are like, hey, the Fed might chill out at that point. Inflation should come down. But the Fed's saying that is not a stopping point. That's not a point they're going to look at and say, hey, we're done. We're going to stop raising rates. They're saying that they're going to go even more aggressive than that. If you're talking 50 basis point rate hikes, you could be substantially higher. 2023 could have 5 or 6% federal funds rates like we seen during 2008. That's going to cause a very large recession. He also did talk about a soft landing quite a bit. And he says, Powell says labor market still solid if jobless rate rises a few ticks, and the unemployment rate is like 3.6%. So he was essentially saying, hey, if the unemployment rate goes like 4%, we're not worried about that. There is 2 job openings for every 1 unemployed person. So that data does suggest that there's room to tighten the labor markets, right, to get things down to a more normal level, as well as to raise rates, basically saying the economy can stand on its own 2 feet. And then Powell says China lockdowns are preventing healing of supply chain. Powell says war in Ukraine looks longer lasting than first expected. Powell says wouldn't have such inflation without supply issues, and that's kind of what he highlighted on a lot. Saying that the supply issues, what we already know, but it's good to hear it from Powell, that essentially the supply issues we've seen, Powell cannot do anything about that, but that is making their job a lot harder to get inflation down, and that's why inflation might last a little bit longer. He did acknowledge the fact that they did not expect supply chain issues for this long, and that they're not going to dictate policy based off of what they think is going to happen. Essentially saying, hey, if China were to open up completely tomorrow and supply chains were to be fine, they're not going to stop raising rates right now just because that happened and look at more data. They're going to keep going and then look at the data as they go. So it's kind of forecasting much higher rates. He did go on to say that the economy has, or I should say financial conditions, the stock market has priced in a substantial amount of tightening, rightfully so, because they are going to be doing a lot of tightening. He's basically saying, we ain't here to help you. We got inflation. We got to get that under control. Whatever happens, happens. If the labor market, gets a little bit worse, if it gets a little tighter, that's what's going to happen. He's basically saying, be prepared for not so great financial conditions, aka the stock market may not bounce back in such an aggressive way as it has in the past. That's kind of what you could boil it down to. Probably not these V-shaped recoveries that you are used to seeing. That's the beautiful thing here, though, with these not a V-shaped recovery, a long-term downtrend, is that you can actually acquire large stakes in stocks over the course of months or potentially a year or two, and then that's where you make all the money once the economy actually comes out on the back side of this. And that's what you guys should be looking forward to, is not necessarily you want the stock market just to rip tomorrow, but you want to have a lot of time to acquire these very large positions. I said this in the last video, but if you make, let's say, $100,000 a year, and you can invest $30,000 a year, 30%, up it a little bit from what you might normally invest per year. That's $60,000. Say if this market is down for 2 years, invested in a lot of long duration growth, a lot of growth companies. I mean, that $60,000 could very easily turn into $1 million 5 years from now on the backside of this, right? Potentially more than that, just depending on what you invest in. And that's the best way to look at this. So I guess it depends which way you're looking at this, but this is not going to give us that relief rally, that major bounce that some people were hoping we would get out of Fed Jerome Powell today. Other Fed speakers pretty in line with what Fed Jerome Powell is saying right now as well. Nothing too crazy coming out of them. Obviously, Fed Jerome Powell is the main guy, and he is going to dictate the markets and what happens by and large. So those are the main headlines that actually did come out, and that's potentially what could move the markets here over the next couple of weeks, right? Powell did just say real chance in near term that globalization reverses. Powell says we'll never say more people need to be out of work. Powell says would love to see labor market that's more in balance. Powell says neutral rate probably well above 3.6% now, should move down. So, it's not a good situation overall. So I would just know that there's going to be a lot of volatility. There's going to be a lot of back and forth moves, and we're probably not going to see some, all-time highs anytime soon. We'll see what happens with earnings, if companies can still do well, or if the economy does go into recession. Those are going to be the key things. But for right now, I would be very, very cautious with a lot of these trades, because it wouldn't surprise me tomorrow the market's down 2 to 3% based off of what Powell said today. Now let's talk about SoFi stock, because we are at a very important level as of right now at $7.07 per share, up about 2.39% on the day. So we have really strung together a lot of very strong days. For context here, we've seen a 4.5% positive day, then a 3.10% positive day, then an almost 20% positive day, and yet yesterday, Wow, why did I think today was Monday? We've seen a 2.37% positive day, and now today another 2.39% positive day. So we've had 5 positive days in a row. A lot of this is down to earnings, but you are again seeing more insider buys that are coming out. One of the board members did buy about 15,000 more shares, and that filing did come out today. As you guys already know, Anthony Noto as well did buy about 39,000 shares also for about $250,000. So that was a pretty substantial buy right there as well. And that is definitely helping to fuel a lot of this optimism for SoFi stock. And SoFi is really a long duration kind of growth stock with a lot of attractive properties with them, right? They're pretty diversified, like SoFi said on their earnings call. But ultimately, when their student loan refinancing business comes back, as I've pointed out many times, if you search up student loan refinance, SoFi stock comes up. It's the first or the second hit on Google search that you actually find. So they're going to boom off of that, and they're probably going to do very, very well once student loans actually come back. People are not going to want to make their payments, and they're probably definitely going to refinance some of that student loan debt. So I think really, 2023, that's probably going to be a big year for SoFi, even 2024, 2025 as well, in terms of their largest segment of their business actually opening back up, which is student loan refinancing, if you did not know. Now, we are at a very important level, because why? Look, this is really the level we were at before, everything started to go through the toilets the last time around with SoFi stock. That was specifically May 4th. We were sitting just above $7 as well, pretty much at the same level we are at right now. And that's where we did eventually fall down from. So if we can string together another positive day, we're going to break out of the prior level of resistance right here. And we are also at a major level of resistance. We have seen resistance a lot of times in the past. In this blue line, this 50-day moving average, you can see just how important it is for SoFi stock on a technical basis. If we can break out of that, you're probably going to see a vicious move back to about $10 per share. That'll be good here for the short term. It'll get people, excited again, potentially, FOMOing back into SoFi stock, especially people that might have sold out. But in the grand scope of things, I do think SoFi stock will probably hover in between $5 and $10 for quite a while. And this is going to give you time to, like I said, load up on your positions if that is something that you are trying to do. But overall, it has been very good. Earnings were good. There's a lot of reasons, in my personal opinion, to be excited for SoFi, and it's definitely rubbing off on the share price today. Now, as far as the put and call activity that is heading onto the option chain, you can see a lot of put activity. Look at some of these large orders. For May 20th, a $10 put coming in at $7.8 million for that position. Are you kidding me? $6.05 million, a July 15th $9 put, a May 20th $15 put for $4.43 million, June 17th $10 put for $1.67 million. So you're seeing a lot of money trying to artificially short SoFi stock into the ground. By artificially short, I mean buying these puts that are deep into the money with a very low break even. So if the stock falls at all, you need to see the market makers going out and hedging out a lot of shares, meaning just shorting a lot of shares on the open market to drive down the price of the stock again. And I mean, it's 27,000 contracts right here. another 27,000 contracts right there, 5,600, and then 5,600. And you guys see these even numbers, 27,000, 27,000, 5625, 5625. This is probably one large investor, one large firm, one large whale that is single-handedly trying to push SoFi stock down right now. So we'll see what happens. A lot of it will be dictated by the markets and how the markets do digest Fed Jerome Powell. If the markets are cool with it, cool with what he says, then, you know, things could be very well for SoFi stock. And it looks like the markets are doing just fine right here and right now. But that is a lot of potential artificial shorting pressure. So just keep that in mind. That is always going to be around here, at least in the short-term future for SoFi. Now, the current short interest of free float is 21.13%. Current shares that are sold short, 153.77 million. Cost to bar max sitting at almost 15%. The utilization is at 100%, and days to cover sitting at 4.28. So this right here looking primed for some degree of a bounce. Now or later, eventually it will come, and when it does come, it's going to be 20, 30, 40, 50% positive days, in my opinion, given how much that we have actually fallen as of recently. Obviously, like we've talked about many times, the institutional ownership 13F filings are coming out. That is extremely bearish. The net gain of brand new positions is quite impressive. 44,000 new shares, 3,700 new shares, adding to a call position by 75.66% by Jane Street Group, decreased their put position by 5%. Virtue Financials increasing their position by about 1,800% in the last quarter. D.E. Shaw & Co. increasing their position by about 23,000%, now owning about 2.5 million shares. Same thing pretty much down the list and across the board. Brand new positions being put on. By and large, look at Barclays, 2.1 million shares bought at about $11.54 as an average cost. They did couple that with a put position to obviously hedge out their strategy here. But you see a lot of green and you see a lot of institutional investors adding to positions. Some of the people that sold out likely did get margin calls, and they were not big positions to actually begin with. So by and large, you're seeing a lot of inflows to SoFi stock right now. But you're also going to see a lot of shorting, a lot of people trying to protect themselves in case SoFi did get any more downside. But now institutional owners currently sits at about 45.75%. 5.32% looks like it is owned by the insider. So you're sitting at about 50% of the company that is held up, usually in more long duration investments, right? These hedge funds, they can flip out of stocks, but they tend to buy and hold stocks, especially if you're buying something that is this beaten down, that really does not have market conditions favoring them. You're probably in this for the long term rather than not. So that is going to be all for this video. As far as SoFi and a little bit more of the specific technicals, right? We already talked about 50-day moving average. You want to watch $5 if we do get, you know, some downside there. The RSI is just now going over neutral. So we're at 51.42, still sitting at about neutral. So even though we've seen 5 positive days back to back, the sell-off was so bad that, you know, the RSI looks like it could continue, you know, to go higher before you really seen any major downside pressure. People talking about the RSI. You're not at that level where you're just overbought yet. The MACD is pretty bullish as of the second positive day that we did see, so that is also a good thing. It could lead to more continued buying, but a lot of artificial shorting activity nonetheless will continue to happen for SoFi stock. So that is pretty much going to be all for this video. Hit that like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. Get your free stocks down below in the description as well. Webull, Mumu, and Public. Thank you guys for tuning in, and I will see you in the next one.